What's going on, everybody? My name is Zach Hartley, and in this video I'm going to walk you through how to get the most benefit out of your tax-free savings account and your RRSP account. Here is everything you need to know. Let's go. Okay, so the first thing I want to do here is just explain what is the TFSA and RRSP, starting with the TFSA. This stands for tax-free savings account, and the first thing that you need to know is that this is not a savings account. This is an investment account. I know it says savings account right in the name, but you're going to get the most benefit out of this account by investing your money that you put into it. I know a lot of people open up these accounts, they put their money into it, and they think they're taking full advantage of it and they're doing really well. But in reality, that money is really not doing a whole lot, especially if it's not in a high interest savings account. So if you just contribute money to your TFSA and leave it there, you're not really doing yourself a whole lot of good. That's because this account gives you tax-free gains. So if you invest that money and you generate a profit, you do not have to pay any tax on that profit. So if you buy a stock at 50 and it goes to 100 regularly, you would have to pay tax on that profit. In a tax-free savings account, you do not have to pay tax at all, and you can withdraw that money at any time and in any amount with no fees, no penalties. You basically have full control over this account, which is really, really nice. The only time that you're going to have to pay tax in this account is if you receive a dividend from a US-based company and a US-listed company. If you meet those requirements, you are going to have to pay withholding tax on it, and it's about 15% of the dividend, but you do not have to pay withholding tax or any type of tax on the actual sale of the asset. The only downside to the TFSA is that there is a contribution limit, meaning that you can only put so much into that account every single year. The nice thing though is that it rolls over and it builds up since you turn 18. So as soon as you turn 18, it basically starts accumulating and it builds up over time. Right now it's at about $6,500 per year that you can put into that account, and that number just kind of gradually increases over time. The big thing here is that if you withdraw money from that account, you can recontribute it in the following year, but you cannot recontribute it in the same year if you don't have room. So for instance, let's say that your contribution limit in the TFSA, you've had it open for 3 years, you're 21 years old, let's say your limit was $20,000. If you put $20,000 into there in year 3 and then you withdraw 10 of it, you had already maxed it out, you've withdrawn 10 of it, you don't get that space back until the next year. But what's nice about that is you also get the new contribution room as well. So you can basically put in the new contribution room plus whatever you withdrew in the year before. So there is some flexibility here. You just have to kind of understand the rules of the tax-free savings account. Now when it comes to the RRSP, instead of being tax-free, it is called tax deferred. That means that there's no tax on the contributions, but you are taxed on the withdrawals. Now, RRSP stands for Registered Retirement Savings Plan. The idea here is that you're going to be saving up and investing for retirement. In retirement, you're probably not going to have a big car payment. You're probably not going to have a big mortgage. You're probably not going to have huge expenses because you're not raising a family. And so you're going to need a lower income. And so the idea here is that the RRSP allows you to save up money when you're earning a lot of it in your younger years and paying a lot of tax on it. You can save some of that money and you can put it away for retirement, and you can save tax on it and pay that tax when you pull it out in retirement. The idea here is that instead of paying tax when you're in a very high bracket, you can hopefully defer that tax and you can pay that tax when you're in a very low bracket, and all that money that you saved during that time period can be invested and grow over time, so that hopefully by the time you actually need to pull it out, your investments have profited enough to cover all the tax. That's the idea, the best case scenario with the RRSP. Now, the contributions to your RRSP reduce your taxable income. That's the real big advantage in the short term here, is that let's say you're in a very high tax bracket in the 40, 42, 44% range. If you contribute money to your RRSP, the money that you contribute will reduce your taxable income, and you will get that money back as a refund at the end of the year, which is really, really nice. And so if you make a lot of money and you're in a high tax bracket, the RRSP becomes more appealing because you will get more money back on your taxes. You can also withdraw money from your RRSP if you meet the requirements for the first-time homebuyers plan. This is a strategy that you can use to withdraw up to $35,000 from your RRSP, and you can use it for the purchase of your first home. That home does have to meet a couple of requirements, and so do you. So make sure you do some research on that. And like I said, the RRSP becomes more and more appealing for high income earners. So how do you use these accounts and how do you actually take the most advantage of them? Well, like I said, the TFSA is really good for investments that are going to grow over time. So in your tax-free savings account, ideally, you're looking for growth investments. You're looking for investments into companies, ETFs, mutual funds, stocks, whatever you want to invest in that is going to grow over time and generate large capital gains, because in the tax-free savings account, you do not have to pay any capital gains tax. So ideally, that is what you're looking for. Now, if you have tons of room in your tax-free savings account and you can't max it out with your investments, the TFSA is also a really good place to keep your emergency fund, because you can keep it in there. You can put it in an interest earning asset and you can make some money on it and not have to pay any taxes on it and still be able to withdraw it at any point in the event of an emergency. So it is good. But if you are maxing it out with investments, that is better. Now, when it comes to your RRSP, this is ideally designed for you to save up for retirement, or if you are younger, to save up for your first home down payment. Keep in mind, though, that any money you do withdraw from your RRSP does have to be paid back over the course of about 15 years, though. However, contributing to your RRSP can save you massively on income tax if you're a high income earner. And so, ideally, if you're a young Canadian, you should always be maxing out your tax-free savings account first. And if you make enough money that you can max this out every year, that's when you should be starting to consider contributing to your RRSP, especially if you foresee purchasing a home in your future. Now, one strategy that I posted about on TikTok that got a lot of attention that people weren't really sure about and a lot of misconceptions came up was this tax strategy where you take the profit on your tax-free savings account on winning positions and you put it into your RRSP. Now, if you want to see the video, go check me out on Twitter. It is on TikTok. It's Zach__Hartley. But basically what I'm saying here is you take profit on your winning positions in your tax-free savings account and you contribute that profit to your RRSP account. This allows you to reduce your income tax using tax-free profits. So you're generating profits, withdrawing it completely tax-free, putting it into your RRSP, and reducing your income to save on taxes using your tax-free profits. So I really, really like that idea. I think it's absolutely fantastic. It works best if you're in a high tax bracket, you're okay investing long-term through your RRSP, and you have to be able to recontribute that money to your TFSA in the new year, which means you need kind of a nice income here. So only use that strategy if that kind of pertains to you, but that is one nice way to get a little bit of extra money back using your profits. So really, really nice. If you're interested in learning any more about this, I have all of my courses for free on Skillshare. You can definitely check them out there. There's a bunch of different courses and I would love to share them with you. Skillshare is kind of like Netflix, but for courses. So you can go through, you can take anything you want, any quantity, you can binge watch all of them if you want. And you get the first month for free if you sign up with the link in the description down below. After that, it's like a monthly or yearly subscription. But I use it like every month. I think it's absolutely amazing, and that's why I've posted my content on there. So if you want to learn any more about that, definitely consider checking it out, and we'll see you in the next video. Good luck trading, good luck investing, and we'll talk to you soon.